Welcome to this session of strategic financial management. Uh, I am really sorry for the delay. There was some issues with the application. So let us continue. In our earlier session, we discussed regarding how does a venture capitalist enters a business organization by funding in its equity, and how does he enters by using conditional loan. And in the discussion, we can see that conditional loan is regarded to be a little bit secured than that of equity, because equity there is no any guarantee of any kind of return until the company makes any profit. But under conditional loans, what happens is that they usually have uh, interest what is called as a very less or nominal rate interest, or what we call as coupon interest. And once after the company starts selling its product, it will have to give a fixed percentage of royalty on the amount of sales that it makes. Now, the third among the most popular kind of venture capital financing is income note. Now, this income note is called as a hybrid financing that combines the characteristics of both traditional loan and also the conditional loan, on which the venture capital firms pays both royalty and interest, but at a very low rate. Now, this is a unique way of venture financing in India and is called as income note. And as we discussed, it is a combination which combines the features of both conventional loan and conditional loan. Now, the entrepreneurs had to pay both interest and also royalty on sales, but the rates are substantially very low rate. Now, some venture funds provided funding equal to about 80% of projects cost for commercial application of maybe indigenous technology or adopting imported technology to wider domestic application. Now, the funds were made available in the form of unsecured loans at a lower rate of interest during the development phase and at a higher rate once after the organization developed. Now, in addition to interest charges, royalty on sales could also be charged. Now, these three are regarded as the most famous or the most used way of entering a venture capital. Now, the next one is participating debentures. Now, what are the phases of operation? Now, the phases of operation can be three, that is, startup phase, initial operation phase, and after a particular level of operation. Now, what happens under startup phase is that the rate is nil, and under initial operation phase, there is a very low rate of interest, and after a particular level of operation, the company had to pay high rate of interest. The next one is convertible loan. Now, what happened under convertible loans is that it could be converted into equity when the interest on the loan is not paid within the stipulated period. In other words, The convertible loan is subordinate to all other loans which may be converted into equity if interest payments are not made within agreed time limit. Now the next one, the last one is there are quite a few more types of financing methods. Now few venture capitalists, particularly in the private sector, they have introduced innovative financial securities. Maybe such as the participating debenture is an example. Now such securities, that is to tell, these participating debenture securities carries charges in three phases as we discussed earlier. It is in the startup phase, that is to tell, before the venture attains operations to minimum level, there is no interest charged at all. After this, a very low rate of interest is charged up to a particular level of operation. Now, once the venture starts operating on full commercial basis, a high rate of interest is required to be paid. Now, a variation could be in terms of paying a certain share of the post-tax profit instead of royalty. Now, these venture capital funds in India provide venture finance through partially or fully convertible debentures and also what is called as cumulative convertible preference shares, or it is also called as CCPS. Now, this CCPS could be particularly attractive in Indian business scenario, since these CCPS shareholders do not have a right to vote, but they, however, are entitled to voting if they do not receive dividend consecutively for 2 years. Now, both convertible debentures and convertible preference shares requires an active secondary market to be considered as attractive securities from the point of view of investors. Now, under Indian context, both the venture capital funds and the entrepreneurs earlier favored a financial package which had a high component of loan. Now, this was so because of promoters' fear of loss of ownership and control to the financier, and because of the traditional reluctance and conservatism of financier to share in the risk inherent in the use of equity. The venture financing mechanism, maybe like conditional loan and income notes, are quite expensive as compared to the conventional loans once the project becomes successful. Now, they involve substantial cash outflows from the entrepreneur's point of view. Now, what the venture capital fund needs is a financing method that does not burden him with cash flow problems. And if at all we take into consideration in developed countries like USA and United Kingdom, the venture capital firms are accustomed to use a wide range of financial instruments. Now, those kind of instruments can include first one, deferred shares. Now, under deferred shares, what happens is that the ordinary shares are deferred for a certain number of years. The next one is convertible loan stock. Now, here what happens is that it is an unsecured long term loan which can be converted into ordinary shares and subordinated to all creditors. The next one is special ordinary shares. Now these shares have voting rights but without a commitment towards dividends. Now the last among that is preferred ordinary shares. Now these have voting rights and a modest fixed dividend right and a right to share in profits. Okay, now from the first session we discussed regarding what is venture capital, how it is there in Indian context. We also saw how it is there in different countries. How does a venture capitalist, enters the different business organization. So let us now see how venture capital is different from that of investment banking, or what we usually have, or from where we usually get the funds. Like in our last chapter, chapter 6, we studied different institutions from where we acquired funds to our organization. Now, all those are considered as investment banking, the traditional ones, the different schemes, and many more. Now, how are they different to venture capital? Let us see. The venture capital and investment banking, can be hard to tell apart from many outsides of the financial industries. But these two types of financial firms are similar. They are also quite different in the work they do. Now, first of all, we'll have to answer the question, what is venture capital? So that would make us understand how these two are different. Now, venture capital is a type of investment capital where the venture capital firm invests in a new or fast growing business or startup that have the potential for significant returns but also a high risk of loss. Now, small startups are not large enough to access the global capital market available to large established corporations. Now, many of these startups still need sizable amounts of capital to scale their business into meaningful entities. Now, venture capital firms fill this gap between proven ideas and scale by investing in these companies, typically by taking equity stakes. Now, this is to tell that, you know, there might be 100 people with 1,000 ideas, out of which some might be very brilliant, but then these individuals who have ideas, they might be lacking fund. Okay, and this gap between the idea and commercializing the idea is always solved by venture capitalists, because among all other kind of financial institutions or investment banking, these are the people who would invest in high risk ventures even after knowing that in the initial years they might be unable to earn any kind of profit or any kind of cash flow, but they invest with the main perception that after a certain point of time the return that they're going to earn would be worth taking the risk and worth the time that they have invested the money. Now, venture capitalists are those investors and firms that provide venture capital, make many different and relatively small investment with the hope that a few will have outside outsize the success. Now the venture capitalists accept that some of their investments will fail and lose their capital. However, the select few should offset those losses with enough left over for significant profits. Now, because venture capital firms take equity stakes when they invest in a company, venture capitalists will often take broad sets at the company and exert significant influence on how the business operates. So, if these are the case, now what do we mean by investment banking then? An investment bank is a in general term to describe banks that assist companies in raising investment capital. Now these banks are generally intermediaries but can also be direct investors at their core. Now they help individuals or business to raise capital. Now, that is to tell, for example, when a company wants to join the public markets via an initial public offering, the company will hire an investment bank to help them handle regulatory issues. It also finds investors and successfully execute the initial public offering, or what we call as issuing of shares for the first time. Or if a company wishes to acquire or be acquired by another company in a merger or acquisition, investment banks will act as the brokers in the transaction, assisting the buying and selling company. Now, investment banks have also helped their clients with raising debt from both the bond market as well as from banks or other lenders. Now, other times, still the investment bank can simply act as a consultant providing advice to a company on financial matters or possible merger and acquisition or opportunities. Now, investment bankers primarily earn their profits by charging their clients fees to assist them in whatever role the bank takes on. Now, this could be advisory fee for advice, broker fees for assisting in merger or acquisition, or any number of other fee structure. Now, some investment banks also have in-house trading business where the bank trades securities to create even more profit. So, what might be the key difference between the two? Now, the first and primary difference between the venture capital and investment banking is that venture capital firms typically invest directly into companies, while investment banks tend to serve as intermediaries in various financial transactions. As such, they also earn their profits in different ways. Now, venture capitalists rely on the ventures from their investment, and investment banks are more likely to charge fees for their services. Now, moving forward, venture capitalists and investment banks also target different prospective customers. Now, venture capital firms tend to stick to high potential startups with big upside. Now, investment banks are more likely to work with established firms that already have the size necessary to access the broader capital markets and also the capital markets globally. Now, by the end of this discussion, what we can tell that at the end, both venture capital firms and investment banks have important roles to play in financial system. Both the kinds of institutions help firms get access to the capital and resource they need to grow and flourish. Now, venture capital firms do it with equity investment in startups that have big risk but big potential rewards. Now, investment banks do it by helping companies manage the complex world of mergers and acquisition, capital markets, and financial intermediation. So, by this, probably we can understand that yes, the institutions, how they have been set up, is same. The funds that is given by these institutions are also used for the same purpose, but then the features, how they work, and the expectation of these two different kinds of intermediary banking and venture capitals are very much different from one another. Now, moving forward, let us try to understand what are the stages in venture capital? That is to tell how does it start, how the work is done, how it is continued along the years, and how this venture capital comes to an end. Now, earlier days of its origin, that is to when venture capital as an idea began, it involved as a method of early stage financing. But then the notion of venture capital recognizes different stages of financing because it is not only in the beginning of a company, along the different stages of the company's lifespan, also the venture capital can be used. Now, it also includes development, expansion, and buyout financing for those enterprises which are unable to raise funds from normal financing channels. And it also provides turnaround finance to revitalize and also revive the sick industry. There are usually three different stages how the venture capital moves along. The first one is early stage financing. Now, under early stage financing, what happens is that there usually would be seed financing for supporting a concept or an idea that the entrepreneur has come up. Once after that, there would be research and development financing for product development. And once after that, there would be startup capital for initial production and marketing. Once after that, first stage financing would be done for full scale production and marketing. Now, the four different things what I said, seed financing might be, or financing for research and development, or for financing of the startup capital, or even for the first stage when the production is done. Now, the venture capital can be financed to any four out of this. But whenever the fund is raised through ventures for these different stages, it is called as early stage financing. Once after the commercialization, the next one is second stage financing, wherein the financing can be done for working capital and also the initial expansion of the company. And that stage is also called as expansion financing. And under this stage, the finance can also be done for developmenting of, you know, public issues also. Or it can also be raised for bridging, facilitating bridging such works or project which helps in bringing the public issues to the company. And the last stage is a stage what we call as acquisition or buyout. Under this, what happens is that acquisition financing for acquiring may be done for buying another firm for further growth, or it can also be management buyout financing for enabling, operating group to acquire firm or part of its business. And also there can be included turnaround financing for turning around a sick industry. So these are the different stages wherein we can get assistance from the final, venture capitalists. But we should always remember that in earlier days, the venture capitalists used to finance only the seed capital. Now, to speak about seed capital, it is the capital which a company requires to start the business at the very early stage. Okay, but nowadays, even for turning the sick industry to a possible profitable industry, provided all the factors that are necessary is available, even for such plans, the venture capitals can be asked for help. Now, the focus of venture capital when it comes to Indian market is on providing seed capital and also financing for high technology. Now, in fact, the venture capital mechanism that is present in India should be used for, you know, not only for seed capital and financing high tech industries, but also for growth and development of enterprise. And it need not be confined only to technology of or technology financing. Now, business enterprises in various sectors need venture capital for financing various stages of development. Now, this broad approach would even help the venture capital firms to diversify their investment across various enterprises. Now, some high tech, some low tech, and thus spread their risk. Now, it does not make a business sense to expect venture capital firms to invest in high tech, high risk startups only. Not only that, now Until now, we studied stages in venture capital. Now, usually, a venture capital would be a outsider to business, and he actually does not know what the entrepreneur is trying to do, or what the business is trying to achieve in the company in the coming future. So in the course it becomes necessary that we make the venture capitalist understand what the business is trying to do, and thereby we ask their capital to be invested in our company. Now, since they are outsiders, and sometimes when it comes to technology, it also can be understood that these people who would be investing might not have the knowledge of technology either. So it becomes necessary that a detailed explanation of what would be done from business should be said to the investor. And it is during that time it becomes necessary that every business organization should come up with its business plan. Now, speaking about this business plan, it has to be studied in a detailed manner. Now, to study this business plan or to discuss, it requires a bit longer time period. Now, it cannot be completed within 15 minutes of time what we have for our disposal right now. Okay, and also in today's class, if we observe, we have discussed a lot of things. Given that you have, you know, given your attention to the class, there are a lot of things that we discussed, almost might be 10 different topics. Now, if at all I start to tell this again, it might be confusing for you, or either you will not concentrate at all. So, the business plan and all other subsequent topics we shall discuss in our next class. Now, wait until I take down your attendance, and after that you can leave the meeting for the day. So, I have taken down your attendance, and one more thing, make sure that you do maintain notes for yourself, okay? Because it is theory, do not think that it is not at all necessary that you would have practical problems to help you. Now, one thing about strategic financial management is that the practicals would be such that you would be unable to solve most of the times. So it is better at the beginning you always try to know the theory of strategic financial management. So I would suggest you all to maintain the notes, and even I would be